Now, if you're still sitting there feeling a little frustrated because you're right around that $145,000 mark, or maybe even above it, you might be wondering, is there anything I can do about this? The answer is yes. And I'll tell you exactly what I would do if I were in your shoes. The key here is understanding that this whole thing is based on your FICA wages, which is the amount that shows up on your W 2 after certain deductions. And the good news is that FICA wages are usually lower than your total gross pay because some deductions come out before they calculate that number. So let's explore some strategies to get your FICA wages down and potentially allow you to retain the flexibility of choosing between Roth and traditional for your catch up contributions in 2026, but simply keep your taxable income lower overall. And first up, the HSA. If you have one of those high deductible health plans, this is absolutely the first place you should put extra money. And I've been maxing out my HSA for years, and it's honestly the best deal in retirement savings. And here's why. The HSA contributions are in pre-tax, which lowers your FICA wages and overall the taxable income. It grows tax-free, and when you use it for medical expenses in retirement, it comes out tax-free. It's like a triple win. And for 2025, you can put in 4,300 if you're single, and if you're 55 or older, you get to add another $1,000. So 4,400 total. If you're on the HSA family plan, you can put in $8,550. And every dollar you put in here reduces your FICA wages, but you need to make sure that it is being deducted directly from your paychecks. And second, let's talk about flexible spending accounts, or FSA. And these are a bit different from HSAs because it's a use it or lose it situation, but they can be a great way to reduce your taxable income or qualify healthcare or dependent care expenses. You contribute pre-tax dollars from your paycheck, which lowers your FICA wages. If you have predictable medical expenses like prescriptions, glasses, or regular doctor visits, or if you pay for childcare, an FSA is a no-brainer to reduce your current tax burden. And just be smart about how much you put in. Don't over-contribute and lose money at the end of the year. And finally, and this might seem too basic to mention, but it's often overlooked, and it's your healthcare and dental premiums. If your employer deducts these from your paycheck on a pre-tax basis, that's another direct reduction to your FICA wages. It's often baked into your benefits package, but it's worth understanding that this is already working in your favor to lower that magic income number. The whole game here is to actively manage your FICA wages if you want to keep that option for pre-tax catch-up contributions open. And don't just let payroll do what they do without understanding the implications.